Hello everyone, welcome back to Financial News, and I have my co-host Paul Munichel from Ameriprise. I'm Ron Jankowski with Channel 4. We'll be bringing you, today is September 7, 2021, we got to get that squeezed in, and today Paul is going to be giving us an update for what took place last month, and then when he's finished with that, I'll give you an update from Ameriprise Financial's notes to us for this morning.
Thanks, Ron. Today I want to give the viewers an update on the current job market recovery. So, although the U.S. real economic activity eclipsed its pre-COVID levels in the second quarter, the number of non-farm payroll positions was still down by 5.7 million from its pre-pandemic highs. That's about 3.7%, and that is through the end of July. Now, employment in most industries is still down from their pre-COVID levels, and that was February of 2020. But some, such as delivery services, is up 14%, warehousing up 8.6%, and non-store retailers up 6.6%. Home and garden retailers are up 5.6%, and residential construction is about 5.1% higher. Amongst others, we have seen some gains in these areas. Businesses operating in the arts and entertainment sector, here's where it gets bad. They're down 16% since February of 2020. And have seen the largest percentage of job lost relative to February 2020. But given its lower number of workers, overall, it accounts for a lower 7% of the total jobs lost. Leisure and hospitality employment was down 10.3% through July, but given its larger employment numbers, some of them being part-time, it accounts for the largest percentage of jobs still missing at 30%. Now, despite the strength of manufacturing activity over the last year, employment in this sector is still down 3.4%, accounting for 8% of total job losses. Also, increasingly, employment in trucking, which has been a notable constraint in recent months, is down by less than an average of 2.2%. This number may be somewhat misleading, however, given that the number of truckers was already tight prior to the pandemic. And finally, fewer government employees at the state level, down about 4% from the peak, and locally down about 3.9%, account for 14% of jobs still missing, with education-related employment in these sectors accounting for about half the losses. So mixed review on jobs, some sectors higher than others, some sectors certainly lower than pre-COVID levels. The economy is going to sort its way out. We hope we can get more of those people back to work.
And this morning, the note we have from Ameriprise is also sharing the U.S. stock index futures are a little changed as investors continue to look past the last Friday's weak job report. But don't you think that's going to change with the unemployment stimulus ending in September?
That's one school of thought out there, is when you're forced to go back to work because the stimulus has stopped. Those areas I just talked about, there's job openings there. So we're hoping some of those people go back to work in those areas. And you're right, Ron, could help the numbers look better.
The yield on the 10-year Treasury edged higher to 1.36%, while the U.S. dollar index looks to end a six-session losing streak.
Yep, nothing out of the ordinary there. With the market pulling back a little bit, you see bonds reacting in the opposite direction.
Right, always. And equity markets in Europe are weaker ahead of the key European Central Bank meeting on Thursday. And any comment on that?
Nothing there. We'll wait and see. They're probably going to hold level just like we've been doing. But you always want to wait and see till you hear that announcement.
And lastly, shares of Match Group are higher on news that the online dating company will join the S&P 500 index. Boy, that has really grown.
Yeah, a lot of people online dating, I think, is
Yeah,
pretty
it's,
normal. I
yeah,
mean,
it's a
typical
normal,
now.
right?
Not that it wasn't normal before. It's just there wasn't online dating when I was dating. I don't think there was when you were dating. So
No,
that's what I meant by
no.
normal. It just didn't
Boy, it
exist.
enhanced itself, unbelievable.
Yep.
The year-to-date index percentage returns are as follows. The Dow Jones a plus 17%, S&P 500 21%, and the NASDAQ all being a plus, and NASDAQ is at 19%.
Staggering numbers. We've been talking about it every week. I mean, that's not typical to see numbers like that. So let's just enjoy it while we can.
Right. We know there'll be adjustments made.
Yep.
Stay with us. Paul will be bringing a interesting topic on your money. We'll see you in a little bit. And we're back with Your Money. Thank you for staying with us. And Paul Munichel from Ameriprise is going to give us a topic on open enrollment and information. And Paul, I'm going to let you take it from there.
Thanks, Ron. I've got 6 questions to help make your open enrollment sections make more sense. And here's why. Because in the fall, many employers often offer an open enrollment period. And for those of you that don't remember, that's the window of time to select your benefits package for the upcoming year. It's easy to overlook this opportunity and maintain the status quo, but this could be a costly mistake given the significant role benefits play in your financial life. So maybe this year you're resolved to review your options with a fresh perspective, maybe a good idea. So consider the following 6 questions to help get you started. Number 1, have you experienced a major life change recently? If you're on the verge of having a child, recently had a graduate from college and enter the workforce, or the job status of you or your spouse has changed, reconsider your health insurance options to accommodate your current situation. If you are experiencing or anticipating major health expenses, you might decide to choose a health plan with a lower deductible, or perhaps you may decide you are better off paying a lower monthly premium with a higher deductible. All things to consider based on your needs. Point number 2 of 6, how do your employer's benefits selections compare to those offered through your spouse's employer? Employers change their offerings from time to time, so make it a priority to compare your options every year. If you're considering changing healthcare providers or opting in for legal assistance, check to see if the professionals you currently work with are covered under the new plans. If not, consider the cost and whether you want to work with someone new as you make your decisions. Point number 3, consider is a health savings account, an HSA, worth using? If you choose a high deductible health plan, you may be able to set up a health savings account, HSA. With an HSA, you contribute pre-tax dollars into the account. The money can be used to pay out-of-pocket costs such as deductibles and copays for medical services that are not covered by your health insurance. Point number 4, is there value in a flexible spending account, otherwise known as an FSA? Out-of-pocket costs not covered by insurance, ranging from deductibles and copays to prescription drugs, eyeglasses, and dental work, can be reimbursed through an FSA. By directing pre-tax dollars into this account, you can reduce your net out-of-pocket costs. However, unlike HSAs, These dollars do not carry over usually from year to year, and any leftover money might be lost. So you'll want to plan in advance to determine an appropriate amount to save in that type of an account. Point number 5. Are there other benefits I should contemplate? So benefit options vary by employer. Depending on where you work, you might have the ability to enroll in benefits such as dental coverage, eye exams, legal assistance, term life insurance, and other specific services that may be useful. Carefully weigh these options to see if they are cost effective. And last but not least, point number 6, what are your financial goals? Kick off open enrollment season by reviewing your financial goals. If you're married, talk to your spouse and realign on key priorities for the next year. Having a clear vision can help you evaluate benefit options with your lifestyle and financial situation for the coming year at the forefront. If you would like additional support, consult a financial advisor before you finalize your enrollment form. And again, if you're working with one already, that's great. But if you're looking for a second opinion or considering working with an advisor, feel free to give me a call directly at 708-226-3412, and we can see if there's a fit there.
Paul, what if a viewer has a question about the open enrollment and what plan they should be searching for?
So you're going to want to reach out to your plan provider in that case, because they have all the specific details on the different options, what they involve, how they work. Usually you'll call your HR number, but someone in the plan area can help you with that.
With open enrollment coming about, there'll be several weeks for one to want to search that out, get the information, and make a plan, make a decision on their plan.
Right, and as I said in my presentation, a lot of people just say, just keep it the same, whatever I had. But that's really not the way to go about this. These things can be tailored to your specific needs, and as we all know, needs change from year to year. So look into that. I mean, you could be letting opportunities pass you by. And
as you get older, your health situation could be changing.
Exactly.
So you have to compensate for that.
Yep.
Well, thank you, Paul, for that. It was an interesting topic for Paul Municle with Ameriprise Financial and myself, Ron Jankowski with Channel 4. We wish you good investment day.